Hello, everyone, and welcome to our part three of Mastering the TCO with Databricks. And if you haven't met me yet, my name is Ruthie Senanaika. I'm so glad you are here joining us today. And with me, I have Blueprint CEO and President Ryan Neal, who has been running this series. And if you missed the first two, don't worry, we have the recordings on our LinkedIn page as well as our YouTube. So hop on over and check those out. But today we're going to go over part three, which is going to be on the topic of accelerating growth. We want this topic and session to be as engaging and useful as possible for you. So if you have questions, we want you to ask them away. So add them into the comments wherever you're watching from, and we will be sure that to answer them live or answer them afterward if you have something a little bit more in depth. So if you have something that you want to ask after, you can always email us at info@bpcs.com for more questions. But without further ado, I will pass things on to Ryan.
Hey, everybody. Thanks for taking the time to attend our latest webinar. As Ruthie mentioned, this is called Accelerating Growth. It's all around driving organizational innovation and financial success with utilizing new use cases and features in Databricks. So this is part three in a three-part series when we really talked about the business of Databricks. Databricks does a great job. And we also have a number of, in a series of webinars around the technology benefits of a platform like Databricks. And we also have a webinar coming up that we'll talk about at the end or at the end of this about kind of ask me anything about Unity Catalog. Aside from one of the things that we find that's missing is a real in-depth discussion around the business benefits of a platform like Databricks and the business, how to be able to quantify the business benefits within a hyperscaler environment of a modern data estate. So here we're going to talk about how we're going to give a very simple and a couple really good practical examples of how AI-powered analytics and predictive insights unlock new revenue streams and then also enhance your operational efficiency. We're going to use a retail scenario that probably many of the attendees, it's near and dear to your heart, and it's a very practical, hands-on example about quantifying the monetary values. As Ruthie mentioned, I'm Ryan Neal. I'm CEO of Blueprint Technologies. We are a digital intelligence solution and products firm. We are a Databricks partner. Last year, we were the Velocity Partner of the Year for Databricks. We're also a partner with all the hyperscalers as well. And we specialize in the modern data estate and help companies get the most out of their data assets and their data estates. We firmly believe that companies that operate their best when they actually have their data strategy and their data platform that's powering their overall business strategy, which is kind of the holy grail for everybody. In the first two webinars, we talked about getting your house in order. We gave the scenario of a legacy data estate and then a modern data estate in a very simplistic fashion, and then a more complicated fashion, which is very much practical to anybody out there that's dealing with any kind of a legacy environment, which just about everybody is unless you're a digital native company. Then the second one we talked about, after you've gotten your house in order, building that solid foundation. The solid foundation for us is really around the definition of optimization and those core principles around data governance and data democratization, and how something like the Unity Catalog can facilitate empowering each of those initiatives. They're critical to having a very effective modern data estate. And we talked about in each of those webinars, gave very hands-on practical examples of how to quantify the return on investment and total cost of ownership of each of those. In this, we're talking about growth. So in this day and age, everybody has to be focused on growth. It's not just providing value into your company. You have to be able to show where cost efficiency is incorporated, but also revenue and profit growth when you're talking about an investment in something like a data state. So we'll talk about the kind of the main principles. The main guiding principles that we have when you're talking about the importance of growth is you cannot, first and foremost, you cannot cut your way to success. And you need to be able to be successful in an upturn as well as a downturn. This is one of the kind of the first fallacy is that we talk about when you talk about calculating ROI and the importance of investing in modernization of technology is efficiency is not the be all end all of an organization. You have to be able to have efficiency and flexibility to be able to establish growth. Not just cutting costs and vendor consolidation and things like that we've talked about in previous webinars. The second principle is your data platform must power your business strategy. So we talked about that. Everybody talks about the buzzwords of making data-driven decisions, but that's easier said than done. And the coupling of the business strategy with the data strategy is really crucial to be able to achieving growth. And then the last one is TCO is not enough. So we've talked heavily in the first two webinars about total cost of ownership, the importance of it, and how to calculate it. But it is not enough. You have to be able to actually show ROI of any asset in any investment. Otherwise, you are just a cost center. You're a cost center that might have a very good total cost of ownership, so you're a very good cost center, but nobody wants to be in that state, and technology definitely should not be put into that category. That's very much a thing of the past. The ROI of any asset needs to be coupled, the TCO, with the amount of revenue and profit that it generates to be able to show how that investment is paid out over time. So in this, we're going to talk about a pretty simple concept, but if for many of the technologists or anybody that hasn't been through the business school or some kind of economics course, you might be unfamiliar with it. So we wanted to do the starting point of being able to talk about have an intelligent ROI discussion. So, and this is really fundamental to quantifying the value of unlocking new features in a data estate. And just to level set, we talked about the importance of actually cleaning up all the legacy. That is incredibly important, and there's an ROI associated with that. You have building the foundation of your data estate, the modern data estate. There's an ROI associated with that, but we want to talk today about growth and quantifying the value of spending and investing in new features that get to driving additional revenue and profit, and that comes down to contribution margin. So the simple definition of contribution margin is the actual price per unit or the revenue that you get per whatever you sell in your business. And then you subtract off the variable cost per the unit of whatever you are selling. And so it's a simple formula of the amount of revenue that you get from something that you're selling minus the actual variable cost of that item. The importance of this is to be able to actually get down to tying not just the use case that your new feature is going to be unlocking, but the actual revenue driver on the other side that is tied to the business operations, and then be able to quantify it back to the actual cost of that investment. Okay. Does anybody have any questions? Is there any questions on contribution margin before I move off of that? Contribution margin is different than gross margin. It's different than your profit margin. It's a significantly different concept, but it's important when you're talking about incremental improvements. Okay, I'll keep moving. So let's talk about a very practical scenario where contribution margin comes into play. It's a very typical situation for any retailer, but we're going to give Starbucks as an example because it shows the value of this at scale. And the value of this at scale just because they have so many locations. And it's also we use this example, but it's also very timely because most of you have seen the news. Starbucks earnings are down, and so they need to be doing this type of analysis to be able to figure out what is the value of the investments they're making in their data estate and their analytics platforms, and how it's actually tying to revenue and profit growth, which they're struggling with right now. So this scenario, why we like Starbucks is just because they have a couple unique scenarios in their business that are really interesting to analyze from a business perspective. So the question is, what is the value of 2 transactions per day? And my story, I've been a barista way back in the day. My mom owned drive-through espresso carts, but I've also worked for other folks. And so I know, you're doing a lot of transactions if you've ever sold coffee, or if you've ever worked in food service, if you've ever worked for a quick serve restaurant or just a restaurant in general. There's a number of different transactions, and every single restaurateur or retail establishment has a high volume of transactions. So we're only talking about two additional transactions per day across an entire fleet of stores. So the value of 2 transactions per day, per store, and per fleet for a company like Starbucks is pretty easy to calculate. So I use an average price of $5. It might vary, but $5 is good for ease of math. And for our purposes, it's pretty good for rough math. So the average price of a transaction, if you assume one particular transaction is $5, somebody comes in and buys a large latte. That the contribution margin on that, and I actually took a pretty conservative approach of the actual the variable cost of that particular transaction at 50% contribution margin. So a contribution margin of $2.50, which should equal at 2 transactions per store per day a total amount of additional revenue of $10, right? So you might say, well, 2 transactions doesn't seem like a lot, and it's only $10 additional per day for a contribution margin of $5 to that particular store. But take a look at how many stores that Starbucks has. They have over 33,000 stores. The average retailer on any kind of a national level is going to have, anywhere from at least 1,000 stores, but then also up to 15,000 stores. We just use the example of Starbucks because they have a lot of locations and everybody's familiar with the brand. So on a fleet of stores, the total amount of revenue per day to a company like Starbucks is $338,000 for a profit per day of $169,000. When you apply that across the entire fleet, you're talking about a pretty staggering amount of those 2 transactions of $123 million of revenue that they actually leave on the table by not having those 2 transactions, or that what they could go out and get, and an actual contribution margin of $61 million. So at that level, it's a pretty significant, each individual transaction on an average across their entire fleet makes a pretty big impact on their bottom line from a margin standpoint. Let's talk about another scenario: inventory management. This is also very near and dear to every single retailer out there and restaurateur. The unique scenario with Starbucks, though, is Starbucks has perishable inventory. So it's not just like an electronics retailer or somebody that's trying to stock inventory and have a safety stock of inventory that, or a clothing manufacturer, clothing retailer that might have some seasonality about their inventory. This is perishable goods. So most people don't know about Starbucks is they have to actually have all of their perishable inventory has to come in frozen to the actual store itself, and it has to take a 24-hour window to be able to thaw naturally for I believe it's health department reasons, or maybe an internal policy. But either way, it has to sit and wait for 24 hours before it can actually be put out. And then if it doesn't sell, it has to be disposed of. Right. So the perishable inventory is really tricky to manage for a company like Starbucks. You'll either have scenario that we're going to give right now is scenario where you either have a not enough inventory on hand to sell, or if you end up with extra inventory at the end of the day and you have to dispose of it. Okay. So the value of the inventory inaccuracy is what we're going to measure, and how do we get more accurate with our inventory? So I took an average of 50 SKUs per store. I don't know if that's actually accurate, but it's pretty close. And then the quantity per SKU of 1,000 per store over. They run at a 18-hour clip throughout the day. So that might be inaccurate, but it's a good for a rough estimate. And I took a cost per SKU based on our previous analysis of the contribution margin. That's that variable cost per SKU of $2.50. That means on any given day, each store is holding $125,000 of inventory that's perishable. And across their entire fleet, they have over $4 billion of perishable inventory. If you take a look at just 1% delta of inventory inaccuracy, the amount of lost revenue is pretty staggering. It's talking about the lost if you have a scenario where you ended up with excess inventory of 1%, you ended up leaving that the revenue, the less than 1%, the lost revenue opportunity is $84 million across their entire fleet, with a lost profit opportunity of $42 million. And then since at a 50% contribution margin, the same thing happens when they end up with additional inventory that they have to dispose of a loss of that $42 million of that cost on just 1% of the inventory across their entire fleet. Which is serious and significant, if that percentage moves, you can see why they end up having a significant problem of their earnings reporting. So let's talk about then how do we get more accurate with our inventory analysis? Well, the only way you can with this dynamic inventory that you have within your system of perishable, it has to thaw, so it's really, really difficult to track. The only way you can do that is with advanced analytics, and all the features that are being released for a platform like Databricks are the way that you actually can get your head and handle on your demand predictions and your supply restrictions. Okay, so typical demand forecasting and prediction was done on a straight line basis, based off of historical data. So what in the retail scenario, it's pretty traditional for companies to be able to do same store sales and same sales from past periods, to be able to estimate what they think the demand is going to be on any given day in the current period. But in high times of volatility, or when you're dealing with something that has volatility around the inventory, the straight line demand prediction and the straight line supply prediction and restriction estimation does not work. You have to have a number of different data points and a number of different data sources with a high level of real-time compute to be able to actually analyze your data. What ends up that resulting is, if you've ever had the Starbucks experience, that when they have inaccurate demand prediction or inaccurate supply restriction estimation, is if you ever go on their mobile app, you'll try to actually in the morning be able to try to order your favorite sandwich, or we always use the sous vide eggs, the egg whites, as a really good example. And you'll see not available at your location. Whatever location you're trying to actually order from, it'll actually say on the app that it's not available at that location. That is because it's the equivalent of a stock out in any other retail scenario where they either had a poor estimate of what the demand was going to be, so they sold through their inventory for that particular day, and in the morning, that's a pretty bad deal for a breakfast item. Or they had an inaccurate supply restriction estimation, and they didn't estimate the amount of supply that was in their, which was in their system to be able to get to those additional stores. And so what ends up happening is typically they will, in a normal retail scenario, they'll beg and borrow from the other locations for additional inventory of things that they've been short. In this scenario with perishable goods, they can't. They can't move inventory that quick between locations. And so what they end up hoping is that the customer will end up going to a different location to be able to find that same item if they are tied to it. Or the other scenario is that they will actually pick a different item. Usually what typically results in is the customer will bulk, and they will either not order at all. You'll miss the transaction for the day. And that is a scenario where they won't just pick up a different item, they will just skip it. Or they'll go to, if they have enough of those situations, they'll end up picking up one of the competitors and go to a Dunkin' Donuts or even a McDonald's in that scenario to be able to get their breakfast item. All those are really bad for Starbucks and erodes the brand. So the scenario that we're talking about here is dynamic demand prediction. And dynamic demand prediction is incredibly important when you're talking about when you're talking about all the different inputs into an actual supply chain that you need to take into consideration when you are when you're running a retail establishment. So I wanted to really quickly go over some of the additional features that are available before we go into the calculation of what those features unlock. So the features that are unlocked with something like Unity Catalog in Databricks, some of the newest features, are incredibly important when you're talking about the advanced analytics and dynamic demand estimation. So you have things like delta sharing. So delta sharing in and of itself is incredibly important for anything, any group with any company that has and needs access and incorporating third-party data and data within its own ecosystem into its calculations. That's typically some of the most difficult to get access to, and to be able to run through not only an ingestion but a processing in order in real time to be able to get same day estimation and demand estimation for a retail establishment. Something like delta sharing that's unlocked with Unity Catalog is an incredibly important benefit to a modern data estate. But there's also AI-powered predictive optimization. So things like that have to do with optimizing the data estate as it goes along the life of its asset, which is incredibly important to be able to prevent degradation of the data estate across the life of the asset. And then there's a whole other set of features like clean rooms and Databricks IQ and all of the AI governance and AI capabilities that power things like advanced analytics scenarios. Those do come with an additional cost. So in this analysis, we're talking about ROI, the ROI of adding those additional features. And we're just going to talk about one particular scenario of unlocking an artificial intelligence and an AI use case in order to be able to power dynamic demand prediction. So in this scenario, we took the total contribution margin of the inventory miss, the inventory opportunity, as well as the total contribution margin of the additional 2 transactions from a revenue generation standpoint. So you have inventory accuracy of the 1%, And then you also have the adding of 2 additional transactions through the ecosystem of preventing that bulk. Okay. The contribution margin of $42 million at the top line and $61 million on an annualized basis, compared with the amount of incremental cost, the variable cost that's associated with those transactions. So the contribution margin already takes into consideration the variable cost of the actual product itself that's being sold, but you have to take into consideration that additional cost that it would take to actually power the single use case. So I took a very easy calculation of 5 additional individuals on an average total cost, total compensation cost to the organization of $200,000 a year, and that effectively it's a typical data science team that's going to go after one particular use case of predictive dynamic demand estimation for retail operations. And then what I did is add in consumption. Adding in that consumption of an additional, say, $20,000 per month of consumption in a consumption-based platform. It's on top of your existing software cost within Databricks, and you can see at a level like Starbucks, you get a 34x ROI on achieving that inventory accuracy, and a 50 times ROI on that spend for the additional 2 transactions per day, which is a pretty clear ROI for any type of scenario. And you can apply the same methodology across any other additional use case that's going to be tied to any kind of revenue or profitability generation.
And Ryan, I'm going to hop in super quick because we got a question that came through. So this one says, since variable costs typically decrease as volume increases, wouldn't some spoilage be preferable to a stock out based on seeking a lower unit cost? How do I dynamically predict ideal unit cost based on demand?
Well, so the good thing about the variable cost is it actually stays constant. The contribution margin, as you increase transactions, that the variable cost is the cost that is associated with each additional transaction itself. It takes away it takes away the it is the cost that's particular to the transaction. And so that contribution margin ends up being a pure cost associated with that additional transaction. It's the additional cost that it takes to complete that additional transaction. And so on a straight line basis, you should be able to actually get and be able to estimate the amount of variable costs associated with your particular use case when you tie it to that actual that actual revenue amount.
Awesome. Thanks, Ryan.
So the interesting thing when you are you'll see when you actually scale this up and down. This is a really good ROI for somebody like Starbucks, but as you scale down, you'll eventually get to a threshold where that ROI starts to decrease and go below the threshold of the cost of actually unlocking that use case. Will actually get down to a 2 or a 1 ROI. That ends up making it that's the point where you end up saying, well, depending on how big my fleet is or how many additional transactions or improvements I can get, you'll end up coming to a break-even point from an ROI standpoint. But you'd have to get down to a pretty these use cases are pretty self-evident when it comes to any retailer of any kind of a size, unless you're talking about a very small fleet of stores. And the best part about it, since it's the important part to think about this is this sunk cost fallacy. So one of the things that underlies here is that one of the principles is that the data estate and that you've already modernized is effectively a sunk cost. When I say effectively is there is something called the sunk cost fallacy where you can't just disregard it, because you have to then take into consideration the increased load on that data estate and what it will do to your overall TCO calculation. But if you remember from the previous webinar, that's where the factor comes in of the growth and complexity. So those are multiples of cost factorization that you apply to the overall cost of either of your capex or your opex. That growth multiple and the complexity multiple is where you take into consideration these new use cases of and so you can apply that to the overall data estate itself, and then segregate the ROI analysis of unlocking these particular use cases. And the easy part about it is any of your Databricks teams, if you're a customer that is either already on Databricks, you'll have an account team associated, or you can actually reach out. One of the things we offer at the end of this is an actual ROI and TCO calculator that you can utilize, and we run workshops, complimentary TCO workshops as well for any of these different use cases and scenarios. So either if you're one of the partners that's on the call or a customer itself, just feel free to reach out and we can actually run you through this. The price transparency that Databricks provides is unparalleled across the entire industry. And so you as a customer or you as a partner can actually dive in working with your account team and be able to determine what that consumption impact is going to be, all of the direct and indirect costs. And then you should know what your overall labor rate is for internally to be able to calculate that labor increase. And then identify any other intangible costs that are associated with that use case, and be able to tie it to the contribution margin, not just on the revenue side, but the actual contribution margin, which is the important part about the business justification of unlocking these use cases. And this creates a very clear case for all of the additional features that are added within Databricks and tying them to the business use cases. Does anybody have any questions on that? Or is there any additional questions from the previous one?
Nothing else, thanks. But if anyone does have questions, you can add it to the comments on whatever platform you are watching from. It'll all be able to be seen live.
Perfect. Well, thanks everybody for your time today. Definitely reach out if you want to talk about what these what new features are available within Databricks, and be able to work through the business justification internally to be able to get them unlocked for your business.
Awesome. Thanks so much, Ryan, for all of that really great information. We hope everyone joining had some really great insights that you're able to take away from this session. And once again, if you did miss part 1 and part 2, we are more than happy to connect with you to discuss that further, or you can watch it on our YouTube channel, and it's also on our LinkedIn as well. As Ryan mentioned, we do have a really awesome webinar coming up. This one is exactly a week from today, and it is on the topic of Unity Catalog Ask Me Anything. And Ryan did go over some of the Unity Catalog features as well in this talk. So if you are curious, if you have questions, if you just want to sit in and listen to what other people are talking about or what other people are discussing, we want to invite you to join this. So I'm going to add the link in the comments right now, and feel free to hop in and sign up right now. We have a Databricks champion from Blueprint who will be running this, and so it's one that you will not want to miss. Thanks again for everyone taking the time out of your day to join this webinar, and we hope you have an awesome rest of your Wednesday. Thank you, everyone.
Thanks, everybody.